Avinash has followed a brilliant career as an investment banker, as an academic, and as a policy advisor at the highest levels. And he is also an authority on the problems of Bailin and so-called COCOs. And I guess he will explain what COCOs are, among other things. He is a senior resident fellow at the Peterson Institute for International Economics in Washington, D.C. He is an emeritus professor at Gresham College and a non-executive chairman at Elara Capital PLC. I'm extremely pleased that Avinash has been able to visit us from Washington, D.C., and I'll tell you why. When I was a bank analyst with the modest task, of attempting to predict the future, I found that his writing were extremely useful after the crisis. And I particularly enjoyed was what Sir Paul said before about bank analysts. The top 10 bank analysts were equity analysts, and that he probably wishes that in the future, the top 10 bank analysts will be bond analysts. I started as a credit analyst, so for me, it has been always very important to look at credit before looking at equity when you need to assess risk. So that was something very nice to my ears. For those who do have an interest in which policies will work in a future crisis and which will not work, few people are certainly better equipped than Avinash to describe what happens when a beautifully crafted piece of financial theory collides violently with the messy reality of financial markets. Ladies and gentlemen, please welcome Avinash Persaud.
Thank you very much, Christophe. Very kind of you, too kind. It's a great pleasure to be here. Now, those of you who followed US politics before Donald Trump will remember that back in 2007, Hillary Clinton was locked into a tough primary struggle with Barack Obama, the junior senator from Illinois at the time. And Hillary used to use in her stump speech the weapon of the 3 a.m. phone call. I wonder how many of you remember that. So according to Hillary Clinton, the real problem was the 3 a.m. phone call. When the middle of the night, the generals will call. And they'll be asking you for some tough decision on defense of the realm. And, she was saying she would be better able to make that decision than her opponent, Barack Obama. Back in Europe at the time, 2007, we had issues with Northern Rock and EKB. I was thinking, she's got this wrong. The real 3 a.m. phone call is from your banker. And the banker's saying to you that unless you bail me out in the next 30 minutes, the entire financial system will collapse. And what do? Do you call the bluff and run the risk that the entire financial system does fall apart, as maybe policymakers did with Lehman Brothers? It's very tough. There's a very lopsided debate because you feel that the only people who really know what will happen are the bankers themselves. And the bankers, and I say this as a former banker myself, the bankers have continuously, before then, since then, at that time, really been involved in serial hostage taking. They take policy as a hostage. They say, unless you do this, there will be a calamity. And the debate is lopsided because our policymakers don't really know what would happen. And so it's very important that Finance Watch exists. It's very important that we have the Systemic Risk Council that Sir Paul is chairing. It's very important that there are these other places to act as a countervailing force for policymakers faced with a great uncertainty, faced with being taken hostage by an industry which says, unless you do as I tell you, the whole thing will collapse. Without that countervailing force, we end up with bad policy. We end up with lopsided policy. Let me talk to you a bit about Bailin securities and Bailin instruments and the process of bail-in. And of course, we're talking about bail-in before a bank no longer can operate, is no longer a going concern. So this new introduction, these new policies, these new instruments are about doing something to avoid the taxpayer coming in to rescue a failed institution. And I totally understand why we have gone down this road. The episode of the global financial crisis, we managed to turn a private recklessness into a public calamity, into huge public sector debts and deficits. And then we had the specter of the state having to save money, extol austerity, cutting welfare budgets in order to finance the past indiscretions of well-paid and undertaxed bankers. I can understand why the mantra went from this time it's different to never again. Never again should taxpayers be in the front line. We need a way of some defense for the taxpayer, letting other people take this risk, spread this risk, distribute this risk better and away from the taxpayers. It's an extremely well-intentioned set of ideas. It's just not going to work. And unfortunately, it's going to make things worse before we realize it. Now, there are, interestingly to me, three fundamental reasons why this isn't going to work. And they are, I say fundamental reasons because they're the kind of reasons that actually have been there for a while and keep on coming back as we keep on trying different ways of dealing with financial crises. Because as you know, financial crashes, financial crises, they're not new. The striking thing is how regular they are. The first fundamental reason why these things cannot work is that we have financial crashes because of a market failure. Financial crashes are not random events. They're not random events of some mishap. They always follow financial booms. And financial booms take place because there is a collective underestimation of risk. And this is our fundamental market failure. The market underestimates risk, sees no risk, and that's how the boom gets bigger and is fueled and financed, and that's why the crashes are deep and extensive. This is the market failure. And so trying to solve this market failure with more markets is already starting from the back foot. It's going to be hard for markets to solve the market failure. There are occasions where we can create a different market and let that market solve it. But fundamentally, our problem is that the markets are not good at estimating risk, and therefore placing more faith in the market estimation of risk with a new instrument in which market players will have to estimate risk is not going to save us. What's going to happen is that people are going to buy these instruments when they have no expectation that they will ever be bailed in. No one buys these instruments because they think they're going to be bailed in. They think they'll always be able to sell it to the next guy before they're bailed in. And so they'll buy them in optimistic times. At one point, as you know, some of these new COCO instruments were yielding 2.6%. Market's assessment of 10-year risk of Bailin, 2.6%. We know there's something wrong here with the ability of the market to price these risks when you're seeing that kind of pricing going on. One of the challenges that financial regulation has is that often the framework that the regulator starts with is the wrong framework. The framework they start with is of one bank failing. It's a common example. One bank fails, and unless we come in to intervene, that single bank failure could potentially be systemic. It's most common, though, in textbooks. Actually, the real problem is multiple banks failing at the same time. Multiple banks failing at the same time because there's something that makes us realize that what they were doing is risky. Banks, ladies and gentlemen, don't generally fail for doing risky things. Maybe I should put that differently. Banks don't regularly fail for doing things they know are risky. When they know something is risky, if any of you have had the misfortune of being viewed by a bank as a risky borrower, will know that when they think something is risky, they either don't lend to you, they require a huge amount of collateral, they have covenants in the loan to make sure they can pull it back at any time whatsoever. They make sure that they are not carrying the risk. Banks fail by doing things they think is safe, and that what we thought is safe becomes risky. Thinking that housing is safe is a common ingredient of banking failures throughout history. Safe as houses, the phrase you know. The number of housing crises that have led to banking crises is a very high amount since the 1970s. So our problem here is that it's not one bank failure and one bail-in. It is that there's a whole investor class who have bought these instruments believing they'll never be bailed in. And then suddenly they're all being bailed in around the same time. And this will make any other bank's bail-in instruments which are not being bailed in, those investors will panic. They will say, gosh, the world is a much riskier place than I thought it was when I bought these bonds, and they will try and get out of these bonds. And the way markets do this, they all try to buy the instrument at the same time, pushing down the yields to 2.6%. They'll all try to sell the instrument at the same time. Because the interesting thing is, many of these holders of these new securities that will swap from being a fixed income instrument to an equity instrument, many of these holders aren't allowed to hold equity. So their only game in town is to get out of this as soon as possible. And as they do that, yields would spike. As everyone tries to get out, the yields will spike. And then the market will say, well, the best measure for risk at the banks are these yields. Who am I to say that the banks are safer than the market is saying they are? And so, in fact, these big jump in yields will be viewed as a signal that all the banks are teetering on the edge of bankruptcy and the banks won't get funding. So these bail-in instruments will bring forward the crisis. And they will make the crisis deeper and bigger in the very place that our central bankers and regulators find it hard to solve in the market. It's one thing saving a bank, or two banks, or three banks, or four banks. Saving markets is much harder for our regulators. And another interesting problem with these instruments is who should own them. Regulators have just about got past the idea that they shouldn't be owned by banks. And that makes sense. If banks were to own these instruments, you'll have a natural amount of contagion. As one bank is failing, the bank who owns the instruments in that bank will then suffer. So they say, no, banks shouldn't own these instruments. And quite rightly, they say that retail investors shouldn't own these instruments. And when you press them, they often glibly say, oh, long-term investors should own these instruments. These are exactly the wrong kind of instruments for a long-term investor. Take a life insurer, a 20-year life insurer. What instruments should a 20-year life insurer own? They should own illiquid instruments that gives them a yield premium over the safest asset because they're illiquid, because they don't need liquidity for 20 years. They have got the capacity to own liquidity risk because they don't need liquidity. Best instruments for them are things like equity, private equity, public equity. Things that go up and down on a daily, weekly basis, but on a 20-year basis, when you smooth out all of those things, because what matters to you is your ability to pay your life insurance in 20 years, that risk of illiquidity is a low risk. These institutions should not own the one risk that goes up with time. And the risk that goes up with time is credit risk. The more time you have when you own a credit risk is the more time there is for that credit to go bust. If I give you a General Motors bond and I say that you've got it for a day, I've given you a gift, I've given you an asset. If I've given you a General Motors bond and say you can't sell it for 30 years, I've given you a bomb that will explode at some point in that 30 years. So the wrong instrument for long-term life insurers are instruments designed to blow up at some point if there's a risk. They carry an extra yield pickup because they carry credit risk, not because they carry liquidity risk. These instruments are in fact quite liquid today. So it's the wrong kind of risk for long-term insurers. And why should we save taxpayers by throwing pensioners under the bus is a very interesting idea. What will happen politically is at the time when all our pension funds who own these instruments, who bought them when they shouldn't have done, are about to declare that they're going to ruin the pensions of their citizens and voters, our politicians will bail them out. So these are instruments that will bring forward a crisis. They're instruments that should not be held by long-term life insurers. And indeed, interestingly enough, what data we do have on their holders is that they're not being held by long-term life insurers. Thank God our life insurers know what they should be owning. They're being held by hedge funds. And I don't think that everything hedge funds do is as bad as what some people in the audience may think. But the one thing I know about hedge funds is they believe they're cleverer than everybody else. They believe that they will always be able to sell before everybody else. And so they will buy them when they look good. And when things start to go wrong, when they whiff, they have the merest whiff of something going wrong in the financial sector, they will be clambering over themselves to get out of those instruments, spiking up the yields early, bringing forward the crisis early. I have described Bailin securities and Bailin for going concerns as fool's gold. I think it's an apt description because fool's gold is actually iron sulfide. It's something that glimmers like gold, but actually makes fire. And we are choosing fool's gold over the real gold, which is more equity. We need our banks to have more equity. Fool's gold will only lead to more fires. Now, understandably, the bankers don't want to give more equity. It's expensive. Despite Modigliani and Miller, more equity to bankers is seen as expensive. They'd much rather raise a bond at a 2.6% yield than sell equity. And so they've managed to persuade the regulators that they will raise more capital, they will have more capital, as long as a big chunk of that capital could be these new instruments, which are cheaper for them to raise and issue than real gold, which is equity. And that's why we have the regime we had. I wrote this, as you know, back in 2014, long before Deutsche Bank, earlier this year, became an issue. But the very dynamic that I'm talking to you about occurred earlier this year with Deutsche Bank. The markets began to worry about whether Deutsche Bank had too much derivative instruments, what was the real net liabilities. The yields on these instruments shot up very sharply. People began interpreting the yield as a measure of the bank risk, and this made the bank have funding issues. Imagine that on the scale of an economy-wide. So unfortunately, there are no shortcuts. There are no free lunches. There are no easy ways out. We have to require our banks to have more equity capital. We do need to have regimes of how do we share the pain and the distribution between bondholders as well as equity holders at a time where concern is no longer going. And I think that makes sense, the old regime, making that a more formal regime, making that clearer. I think some of the new notions, and Sir Paul was worried about the rumors of potentially removing subordination and maybe allowing a bail-in of deposits. I think that would be a very dangerous thing indeed if we start to have bail-in of deposits. I know we tried it in Cyprus, and we've tried it oddly. And you know, one of the I'm a lover of Europe. I should be voting in a particular way on the 23rd of June in the UK. But I have to say the way we treated Cyprus so differently than other countries, merely because of their lack of political presence, did dismay me. If a trend were to develop where depositors and European banks believe they have real risks of being bailed in, I think it creates a whole new set of dimensions. In the earlier debate that we talked about with fintech, you know, I think one of the distinctions that was not brought out enough was the distinction between money and investment. And money is what you have in a bank account in a deposit-taking institution with deposit insurance that's regulated, which has access to clearing and central bank liquidity. That's money. Much of what else we're seeing are investments. But if you start messing with money and start saying it may be money today, but it may not be money tomorrow, I think that we run very real dangers in our system. So we need more equity. We need to have a formal system of sharing between bondholders and equity investors when an institution is no longer ongoing. We need to have formal bad banks, and worse come to worse, we sometimes need to have nationalizations, temporary nationalizations. In fact, the whole idea, and let me end with this point, the whole idea that somehow we can privatize bail-in is fundamentally privatize the rescue of the financial system is fundamentally flawed. The financial system cannot self-insure itself against systemic risk. The degree of capital, the degree of liquidity you would need to be running at all times for that to be the case, that you could always exist whatever the systemic crisis, would be intolerable for your banking system. In fact, you need a different economic system. And indeed, it's very odd because there's one person who has liquidity at the time of the crisis. There's only one person, and that's the government and the central bank. And so we're saying to them, we don't want your liquidity at the time when you're the only ones with it. We want the system, which is suddenly short of liquidity, has no liquidity to insure itself. That's not going to work, ladies and gentlemen. So I know there are deep political misgivings about taxpayers being involved. And I understand that. And I understand that because the consequences of what this did to public sector balance sheets and to government debt. And we need to be tougher on our bankers that are bailed in, although it's easy to say. I was once on a committee where a government agency had semi-nationalized a bank, and this particular bank had a lot of derivative instruments, and we were being asked, you know, we need to hire the very people who came up with those derivative instruments to help us explain how we get out of them. In fact, we don't just need to hire them, we need to give them a bonus, because otherwise they'll go somewhere else. Think of the politics of that. So these things are much easier to talk about than to do in reality in a crisis, and I understand that. But we do need to find ways of being tougher with our bankers and having greater sanction so that the end result of the taxpayer coming in really is the very last resort. But trying to find a cheap shortcut, fool's gold, self-insurance, privatizing bailouts, using markets to deal with market failures, sadly, ladies and gentlemen, it's not going to work. We've tried it before. We will try it again, no doubt, but it won't work. And indeed, I believe it will make things worse. Thank you very much indeed.